Shares for beginners.
Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
I think systems are great, right? Like a framework when you're investing, a framework around your risk, around your goals, around how you believe you have an edge, if you think you have an edge, or how you're just going to invest and get a return on your money. A framework and some kind of heuristics and rules around that's great. I think, that's awesome. Another great piece of information is, again, it's kind of like context is king, because if you track your transactions and you're disciplined with your transactions, you will save about 4% a year.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. When is a company cheap? What's the difference between the fundamentals of a business and what the market expects in the future? Joining me to discuss is Charlie Meaden from gembot.ai. G'day, Charlie.
Hey, thanks for having me on. Really appreciate coming here and talking about investing.
So Charlie was originally trained as a goldsmith, and the money from that career helped him get into technology, where he got involved in a recycling startup in the US, where he ended up building their first product to help incentivize college students to recycle more. With a bit more confidence, he moved into building a gaming platform called Uproar, which grew to over 400,000 users and was sold. Oh, you say not a major success. Why do you say that's not a major success?
I mean, when you start a startup and you have the ambitions of taking over the world, you have an end state that you want to get to. And the journey didn't get to the path that we believed it could have gone to. And, we went with an approach that worked for us at the time, but wasn't what we originally envisioned. But we learned a lot along the way, and you can see other players in the market that took it further than us. As an example, Skills, which is a public company now, which did some similar stuff to us.
So you were expecting a unicorn, were you?
Yeah, I mean, that's what we were doing. Yeah, that's why we went out to do it. We wanted to, incentivize gamers and provide kind of air miles for video gamers and a place for them to compete and basically engage with gaming and esports. And we did that. So from that perspective, it was a success. But, did it become a $300 million company? No. So you've become an investor in the meantime then. You've focused your attentions on investing. When did that start and what was that transition like? Yeah, so, leading up to the acquisition, which was like an acqui-hire, I had some extra capital and I didn't have enough capital to do angel investing effectively, which was originally what my interest was because of technology and my passion for technology and startups and building businesses and creating. So I started to look at public markets and how could I come up with a worldview that was constructive and worked for how I thought and looked at the world. And then how could I basically represent that through investments? So I spent many years researching and reading many, many books with many different disciplines in the investing world when it came to, from quants and AI to fundamental value investors to Austrian economics and reflexivity and the psychology of the market, and then becoming a real fan and, reader, listener, researcher of history. And history is great because it shows you what sort of market psyche and market behaviors happen in the past, and you can garner a lot of information from that, recognizing the fact that it's not the same and it's not going to be like we've had before, but there might be some similarities and some technical kind of wisdom that you can gain from that. So after probably 3 years of reading books, I came up with my own strategy, my own systematic strategy that worked for me.
And it's a long-short strategy. So break that down. Long is like you're buying a share and you're hoping for it to go up, and then short means you're going to make money if it goes down.
That's right.
How do those two forces balance out with each other?
Yeah. So originally, because of the timing of the market, it was very much focused on going long on companies where the market basically expected that there was some sort of permanent impairment to the business that was going to mean they were never going to be able to develop, and their share price reflected that view, that consensus view. And, we were briefly talking about reflexivity before, but basically looking at where there had been a disconnect from the fundamentals, where the market participants, the largest group of market participants, basically their expectation had become divorced with reality. And then I would buy the stocks, and I had a very specific way in which I have rules that I go about my portfolio construction so that I can, dollar cost average effectively, so I can have decent position sizing and I can hold on to these positions and have some volatility in this strategy. Remember, this is a single strategy. I have other assets and, put other money away in other kind of constructions because that's for that part of my wealth, right? But with my active strategy, it's about finding where the market's expectations are kind of divorced from reality.
Isn't that what they usually call value investing? Just finding undervalued companies?
It's also about price, What really matters? What really matters is what someone's willing to pay in that moment in time. But fundamentals, they guide, they're a kind of guide to some sense of reality, right? So it's a mixture of understanding not just, okay, what is cheap, but what's the market expectations, and are the market expectations going to grow? Because, look at Nvidia right now. Looking in October, is it going to be fundamentally cheap in October? No. But recognizing that the market expectations could become very, very kind of creative, right? And you can compound out really interesting growth around AI and, hardware. But is that going to eventuate in a linear kind of 40% a year compounding for the next 5 years for them to validate that valuation? Or are a bunch of retail investors going to end up, holding the bag because institutions have decided to get out?
Well, let's break down the Nvidia story. So Nvidia are a chip maker, basically. They make the chips that power the cloud and all the computers we use and so forth. That's right. Is that correct?
Yeah. And
they've just had a huge upturn in price.
Well, yeah. And they're executing well. They're now increasing their revenue because there's a cyclical cycle and an investment into AI and GPUs specifically that is dominating headlines, dominating investors being like, I need to be in AI because AI is interesting and it is a platform shift in many ways. But what does it mean for hardware? And, are the $1 trillion worth of CPUs going to really turn into GPUs? It's the expectations versus reality.
Let's just break that down again, because CPUs are the basic central processing units.
That's right.
What's a GPU? And this is more necessary for AI that suddenly everyone is talking about and wants to be involved.
And GPUs have also been successful in other areas, right? Because they're in gaming, they're in crypto. Obviously, because they're in gaming, because of the computation and the graphical nature, you're also looking at the metaverse. So there are these interesting plays where you can see, there are markets for these GPUs and people want them and people need them right now, or they definitely feel like they need them. And, businesses like Tesla, like any competitors to OpenAI, Twitter, Facebook, Google, they are all going to invest in GPU capacity. But, that's also going to lead to competitors driving into the space and trying to take some of NVIDIA's margins. Because right now, obviously, NVIDIA has a huge market share, but that tends to mean that there's more competition. Not to mention software and the deflationary effects of optimizing the code, optimizing the models, finding new ways to run these models on bare metal, repurposing CPUs. Potentially, we don't know where the technology is going to go. But what we do know is that NVIDIA is like a staple for artificial intelligence and what it means to kind of move into that era.
So is that kind of, we always hear about the picks and shovels story that, you don't want to invest in the vibe of something like artificial intelligence or lithium, but then there's other companies that will profit by companies pursuing this kind of trend-setting aims.
Well, NVIDIA definitely is the shovel, right? In many cases. So from that case, they're going to benefit greatly. The question is, are the revenue expectations that the market has in line with what will actually eventuate? And these things, like I said, are cyclical. So there's a heavy demand. People go, they try to invest very quickly and then that cycle's done. And their revenue's technically down still year over year. So we know that these things happen in cycles and people get very excited about investing themes. And that drives prices. And sometimes that drives prices to a point where expectations misalign with reality, and then there is a repricing in that asset.
So what was the actual numbers? How much did it go up by? And this was only like 2 or 3 weeks ago, I believe.
Yeah, I mean,
we're recording today on the 15th of June, 2023, just to time
NVIDIA right now, year to date, is up 200%.
That's bad.
I mean, it's an incredible run, driven by a very poor year last year in the market, specifically in technology, very oversold environment, and then some really good news for the industry that they're in. And they do have that competitive advantage right now. So we can obviously see from their stock prices a representation of people's excitement for the potential of artificial intelligence. Is that going to collide with, the economy
reality?
And reality or other variables, right? Which basically adjust expectations and the reality around those expectations.
So how does that compare with the NASDAQ? Because the NASDAQ's been pretty good since the beginning of the year as well.
That's right.
Relative to that, yeah.
Well, so if you look at the trade right now, it's about 7 names that have dominated the performance. The S&P is barely up. If you take out the 7 names that have driven the rally, it's clear. And we saw this with the Nifty 50 back in the day.
Is that the Indian stock exchange or?
No, it was the stock market. I think it was in the 60s. Yeah. And the staple companies, the largest cap companies dominated the market. There was no price too high for them. Mm-hmm. And now no price is too high for big tech and AI. And you see this at the end of cycles. There's a perceived safety in, the largest companies, and it creates concentration and it creates a more crowded trade. So for me, I love reflexive cycles, but I personally prefer to trade where no one else is trading or where the trade is relatively contrarian, just because I don't want to be caught into a very crowded trade.
So you said reflexive in that answer, and we're going to talk about reflexivity. So where did the idea come from? How did you discover it? And
I've not invented anything here. I have just learned from others, right? I'm sitting on the shoulders of giants. Yeah, in many cases. And in our strategy, that's how we've taken my personal expertise and kind of unique take on the world, and then merged that with a systematic approach for one, with my background in programming, and then utilizing very smart investors' experience and wisdom to then create rules around how we invest. And reflexivity is by George Soros, and it is basically reinforcing market expectation that leads to drastic moves in price action, which then, when the expectations divorce from reality, very similar to mimetic behavior, which then leads you to memes and meme stocks. And it's the perfect example of a reflexive cycle that turned out to then shift, and reality had to change, and those assets repriced dramatically. So that's kind of a very short way to jump from reflexivity to mimetic behavior, which is a riot and starts in a football stadium, but it started from 2 people having a conflict, right? And then that moves you on to memes and meme stocks, because these were social movements, really. And a very great example of a reflexive cycle that ended up in, drastic up and then a drastic down.
Okay, so when you're saying mimetic behavior, are you referring to the GameStop saga of a couple of years ago as an example of that?
Well, yeah, that is an example of that. Mimetic behavior can be outside of investing, of course, right?
Yeah.
So
I know we've all seen the memes going around.
Yeah, that's right. There's always those memes that you have an affinity with, and a meme that will remind you of a time, but also it's that sharing of that meme. It's the resonating of that meme that creates viral posts, right? What is a viral tweet? It's basically a meme. It's mimetic behavior. It's people being like, oh, yeah, I agree, right? And you see that with obviously politics, right? Being so kind of divisive in the modern era. And it's because these mimetic kind of cycles with the internet can be very fierce and very quick.
So do you believe that the speed of this mimetic behavior has increased because of social media and the internet in general?
Yeah, there are just more nodes, right? And the thing about AI and generative AI is, those are new nodes. Those are new nodes in the game that are going to affect outcomes because they're participants in the game. For me specifically, I can use agents and algorithms and just systematic approaches to have 6 different views on the market and allocate in 6 different ways. And that's essentially 6 nodes doing different things, along with me on top of that, kind of being the kind of composer of that.
So let's just bring this back for beginners for a moment. From what you've learnt, what should newcomers be aware of and beware of?
What you need to be asking, what I believe, or let's say what I ask myself, right? Or how I would say, I approach it is that I think about, is this behavior somewhat rational, and can I then take it back to first principles? So basically, Saturday Night Live, Bitcoin at 60 odd thousand, Elon Musk going on to Saturday Night Live. Is he going to talk about cryptocurrency and Bitcoin, or is he going to talk about space and electrification? Probably space and electrification. So when like Bitcoin's at 60 or 1,000, I'm thinking, oh, this is very exciting. This price of this asset's going up and this guy's going to have this TV show. Like, what changes, before and after the TV show, right? And how does that go to 100,000 or whatever the expectation is? And the best way to do that, or the best way I found to do that, is taking it back to the fundamentals. Like, okay, if I'm interested in Ethereum, and this is kind of getting into crypto, which I'm not necessarily bullish on, I'm not at all. But just a quick example is, can I compare Ethereum to a traditional business that makes revenue? And if I can, then maybe I can work out what price I'd be willing to pay for that. And that's the same with any asset when there's a lot of excitement, right? Is, okay, when I look at the revenue of NVIDIA in 5 years, where will it likely be? And am I okay with paying $1 trillion for a company that might do, I don't know, 30 to 35 billion in a year? Maybe not. And am I going to be the person that could potentially be holding the bag on something, right? There's a lot of excitement, there's a lot of momentum and fear of missing out. But the great thing about investing is there are 2 things that I love about investing. One is, me and you can take completely opposite sides on a trade at exactly the same time, and we can both be profitable. Mm-hmm. That's one thing I love about investing. And the other thing I love about investing is that you don't have to do anything, and this is where stock market for beginners, or stocks for beginners, the stocks matter to a degree, but it's like the environment you create that's really going to dictate your success in investing. And that's, how do I reduce my expenses? How do I continue to purchase assets? Those are the 2 things. Is, can I reduce my expenses, and can I take that excess capital, and can I consistently build my asset base?
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
And presumably manage risk as well, and to cut your losses as well.
And that depends what approach you want to take. For me, I like to manage my own risk, and I put a big emphasis on, the strategy that I've built, because it manages a large part of my liquid net worth. And that's how I want to represent my view on the market. However, I do have dividend-based investments and a pension or a KiwiSaver, right? So I have those as well that I contribute to that also has its own role. And because I'm an active market participant and I love investing and I love markets, then that reflexive strategy is, where I expect to kind of put my active effort in. And obviously I've automated as much as I can, and I use generative AI and different tools to reduce the amount of time I'm spending to manage risk and find new opportunities.
When we first chatted, you also sent me an article that you'd written. Was it on Medium or Substack?
Yes, Medium.
I think it was Medium, yep. And that's about a coming debt crisis. Tell us about that. Why are we heading towards a debt crisis, and what's that mean for all our investments?
So the memo was probably one of I happened to be in the right time with the right headspace to gainer view that was kind of consistent with what, then obviously proceeded to play out. And the title was How to Fight Inflation in a Deflationary World. And the point there was basically we're going to have inflation because of all this money we've printed, and we've just destroyed kind of the integrity of currency and productivity in general by distributing out lots and lots of liquidity into the market that took assets up very, very quickly and created a mimetic and reflexive cycle of asset appreciation, mixed with the fact that you're also going to have a lot of automation, AI, and deflation long term, right? So the jobs are going to look very differently, most likely in 5 to 10 years. But right now, obviously in 2021, we had inflation that was going to make managing debt much more difficult. And that's what we're seeing now. And what we're also seeing, of course, alongside that is that certain parts of inflation aren't going down. So it's a very complex time. And, if you look at any famous investor right now, they're saying this is the most difficult time in my life, not my life specifically, in their lives, to actually allocate risk and buy assets. So what does that mean? I mean, obviously a lot of time has passed. It was September 2021. I encourage obviously people to check it out because I do think it was a valuable insight, but obviously the time has passed now and it's irrelevant, right? Because all of that has happened. So what's next? And I think how you treat your investments and capital, right, is based on your goals and objectives. If I'm running a systematic strategy and I'm trying to generate alpha, that might look very, very differently to someone that's accumulating to 3 ETFs that align with their risk profile, right? So I always encourage people to learn about investing and gain wisdom and knowledge, because that's obviously the third thing you can do other than reducing costs, saving regularly, but it's also gaining knowledge. And obviously generative AI is creating an opportunity for people to learn quicker potentially and gain context very fast, specifically as well about history. And if you have an insight to history, you have an insight to human behavior. And that may help you be wise in managing risk when it comes to markets.
Okay, so you used the phrase allocating risk.
Yep.
And that's a different way of looking at investing in a company, isn't it?
Yes.
Because you're exchanging your dollars for taking on some of that company's risk. Is that the case?
Allocating, yeah, okay. So allocating capital, let's say, right? Allocating capital while managing risk. What does the big picture mean? I think it's really important to have a good understanding of money, right? Because that's going to obviously be how you exchange in assets. So understanding, when devaluation of currency is happening, that's helpful. You don't need to become an expert, but it's good to just know if you can, and asking those questions.
What it actually
and what
means,
it means.
Yeah.
So, and as your pool of capital gets bigger, you then start thinking about risk and hedging and how you want to allocate your capital and allocate your assets. So I think about when allocating assets, when I'm buying companies, I'm thinking about how productive is this company and is it going to be increasing that productivity for the next 5 years? And it's a bonus if the market hates it, right? If the market thinks, for example, when I was buying Tesla in 2018, the market thought they weren't going to be able to ramp their car, their Model 3, a mainstream vehicle. And they have absolutely done that in an incredible fashion. And they have one of the most spectacular revenue curves, in history. And obviously mixed with that, you've got a lot of interesting opportunities, long-term potential for that business. And they know how to execute. They know how to be productive. But for me personally, now the trade, is way too crowded. The price is not where I want it. It's not my style of thing, but I can recognize that they are productive. But does that align with their valuation or what I'd be willing to pay? Because ultimately it's what I'm willing to pay. Does that align with, how I view the world or the data that I look at? Because I look at a number of indicators and a number of ratios that dictate whether I would be even interested in an asset.
Do you consult charts and have a look at where the price is going as part of your strategy?
big, for me, I take on themes, really. I take on groups of assets with themes, and I'm willing to let that play out over 9 months, a year. I do some technical analysis. I do kind of look at it, but ultimately it's not the main driver. The main driver are theses and themes that are going to play out over a period of time longer than, a 4-minute candle or a 4-hour candle. But I use the technical analysis as context because I shouldn't be ignorant to the price movement of the stock, but I'm definitely not going to be like, oh, well, because it has a certain shape, it's absolutely going to do something, because market participants might defy that.
Yeah, there's very little predictive quality in technical analysis, but it's a good way to just have a look where the price has been.
I think systems are great, right? Like a framework when you're investing, a framework around your risk, around your goals, around how you believe you have an edge, if you think you have an edge, or how you're just going to invest and get a return on your money. A framework and some kind of heuristics and rules around that, that's great. I think, that's awesome. It's kind of like context is king, because if you track your transactions and you're disciplined with your transactions, you will save about 4% a year.
How does that happen?
But that's what the studies show is it's about $2,000 a year. And if you look at the median income, it's basically 3.5% to 4%. But it's kind of that being intentional about that view, right? What's going in, what's going out. Same thing applies to investing. If you have a framework, then when it gets difficult, you can kind of lean back on the education you've done for yourself and history to kind of get through that volatility.
We'll get back to the show right after this brief message. Why am I buying, holding, or selling a share? If you can't answer that basic question, then you don't have a plan. The best investors are ruthless in executing their plans. I've been fortunate to meet many great investors on the podcast. Tony Kynaston is one of the best. He has a clear and systematic approach to investing that is honest, sensible, and methodical. It's called QAV, Quality at Value. QAV now offer an excellent light plan for only $29 per month. You can follow their buy and sell recommendations and learn the ropes. And the first month is free using the promo code SFBLIGHT. Go to qavpodcast.com.au to sign up. That's qavpodcast.com.au using the promo code SFBLIGHT. Past performance is not a guarantee of future returns. Please read the QAV FSG and consult a financial professional before investing. I receive a small commission for services I recommend, and I only recommend services I use myself. But that's a difficult part for a beginner, isn't it? Working out what that framework is going to be. What are some of the questions you would suggest that they ask themselves to work out what framework suits their investing style?
I usually start things off with the goals. What do I want to achieve? What's my objective? What's my immediate objective, intermediate and long-term objectives? Because that can then help me work out, okay, how much of my income am I going to invest? And then beyond that, for me, I start thinking about, okay, well, how much of this pool of capital do I want to do? And how much do I want to delegate off to someone else, whether it be a super or KiwiSaver, or fund?
ETF.
Or an ETF, exactly.
LIC,
Exactly. Or a modeled portfolio, for example. And then how much do I want to allocate to my own active investing to try and generate, non-linear returns, should I say, right? So putting in, some rules around how big you want positions, how diversified you want to be, how much you want to actually allocate yourself, and then really leaning on people that have come before you. And they don't just have to be investors either. A lot of the insights I've gained and that I've applied to investing have come from non-investing advice and wisdom, Have you got an example? There's a book by a professional poker player in the US, and she's amazing at poker, but she's a business coach as well. And she talks about thinking in bets. And I do this not just with investing, but this applies to anything where there's incomplete information. So, but it's all about, am I happy with the decision I made? And I'm not connecting that to the outcome, because the outcome might not be desirable, but did getting to that decision, you've got to be okay with kind of getting to the decision. And then if you disconnect the outcome, then it's easier to make decisions with incomplete information, because what I want to be happy about is, based on the information I had at the time, did I make a decision I'm happy with? And if not, why is that? With the benefit of hindsight.
And what new information may have presented itself in the meantime. Yeah.
That's right. And if something's changed, then obviously I have to reassess and make a new decision that might then have some outcomes that are desirable and undesirable. But it's about, really disconnecting from the kind of identity of outcomes and decisions, I guess, because it's the outcomes that tend to affect us more than the decisions, if that makes sense.
It does. Now, as we were hurriedly putting together the topics for this podcast before we started talking and hit record, you mentioned an Austrian economist, and I can't remember his name. Was it Schrager?
No, it's Mark Spitznagel.
Mark Spitznagel, who's associated with Nicholas Nassim Taleb, I believe.
Correct. And they run a fund together, and they do tail risk hedging.
Yep. But just to start off with this, reading The Black Swan by Taleb was something for me that changed my life. Just the idea of the black swan is that it's an unexpected event. You don't expect, there's something that's so totally unexpected. And it made me so realize how unexpected events can be. And he gave the great example of, the MGM Casino in Las Vegas in the book, and how they insured themselves up the wazoo for everything. But, for example, they had the line taming team. They ensured that a lion would not attack someone in the audience, but they had no insurance that the lion would actually attack and kill either Siegfried or Roy. I can't remember which one it was. They also didn't realize that one of their employees, rather than putting in a piece of paper that had to go into the gaming board each month, he wasn't doing it. And for years, he was just putting him into a filing cabinet and no one knew. And they had no idea that this action was going to cost them hundreds of millions of dollars in fines. And it really brought it home to me for what a black swan event really is. It is that unexpected that you can't foresee at all.
Interestingly, so I love the Black Swan and I've read it.
Was I correct in that characterization, that story?
Yeah, it was really good, actually. And it talks about the unknown event. However, if they could have easily rationalized that, right? Because it was a problem in plain sight, right?
Yep.
So there's another book called The Grey Rhino, which is by Michelle Wacker. Hopefully I pronounced her name right. And that it's like the Black Swan, very similar, but it kind of is saying, no, these are actually not black swans. These are grey rhinos and they're stampeding towards us and we just choose not to look at it. So, I like the Black Swan approach and I like what they've done at Universa, which is the funds that they're a part of, Mark and Nassim Taleb, and they buy insurance, right? So they buy insurance all the time. They buy insurance so that when an event happens that is unexpected and a black swan, then they might be able to benefit from it. And that's where Austrian economics comes from. It's all about buying insurance so that these events that aren't supposed to happen, that always happen, are then covered. And, a lot of them are spending kind of 3% a year, I believe, on that insurance and taking a lower return during good years. And then in very bad years, not having that drawdown, which the drawdowns can really affect your portfolio, right?
And that's the point. I mean, we're talking very theoretically here, but the point is that these kind of events do affect markets. And you don't know where they're going to come from, how out of left field. We didn't expect a pandemic in 2020, at the start of 2020, but these things do suddenly happen and nobody expects the Spanish Inquisition.
Exactly. Yeah, absolutely. But some people do. Right. Some people see these things coming and they just happen to see them. Not everyone's going to see them, but some people see them and they get an inkling and they're like, oh, maybe I should do some digging. Maybe I should do some kind of research around this and look into, what are the potential unintended consequences of what's going on, around, like, for example, credit card debt that's going through the roof in America, right? What are the unintended consequences of that? And is that going to affect anything else? Is that going to affect my portfolio? I guess is, what a lot of people ask. But it's about personalized goals and kind of approach. So if you want to buy growth companies and hold through long cycles, you're going to have a lot of volatility, most likely in your portfolio over the long term. But if you're right in your picks and your approach, then that could compound at a great rate over a long period of time. Doesn't necessarily though mean that you won't have some drawdowns.
Everyone wants to feel like they're Michael Burry in The Big Short, don't they?
Yeah. Stanley Druckenmiller said this interesting thing the other day in an interview. He was like, shorting's a lot of fun, but I'm not sure I've made much money from it. And, if you're shorting, there are a lot of people that are incentivized for your short to fail.
Yep.
And it's a great way to represent a view. But when it comes to shorting, it's costing you money to be in the trade, and you may end up putting yourself through more harm than you need to, right?
Yeah.
Making it too complex.
So tell us about Gembot. And is it still in the stage you're tinkering in the shed with it, or how far off are you launching?
So, we're taking on customers that are a great profile for us that we want to work with and basically help people manage and execute their investment strategies and be essentially a AI investing assistant and wealth management platform in your pocket. So wealth managers cost $2,500 to, $10,000 plus a year. Can we help people basically manage their own strategy for their wealth and then allow them to execute that and learn, use the generative AI and use systems to gain more insight and kind of marry that with your goals and your risk appetite to then make investing easier, but also saving time and making sure the cost is low. Because without, financial advisors and wealth managers, you're able to bring the base cost down potentially, and then only engage with those professionals perhaps when it's the right time without having this huge kind of blowout of costs. Because in the early days when you're trying to accumulate, you need the cost to be low and you need consistency. And ultimately, Gembot aims to help people get rich slowly.
Okay, so what's the web address if listeners are interested in finding out?
So if any of you are interested in becoming more systematic and utilizing AI and automation into your investing journey, then come to gembot.ai and join our waitlist for our multiple features. And I'll most likely reach out to you personally and show you through the product and get your feedback and get what your issues are as investors in this market and what you need solved so that we can help, train our agents and train our AI investing assistant to fulfill that better for you.
Fantastic, Charlie Meaden. I think we got an episode out of that with very little preparation. Thanks for joining me.
Thank you. Really appreciate it.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player or tell a friend who might want to learn more about investing for their future.